Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Friday, March 12, 2010. We'll start today's broadcast with a look at the euro-dollar pair, which finally managed to break above the 1.37 area, as well as the 1.3735 high we had seen on March 3rd. The 1.37 area had also corresponded to a downward sloping resistance trend line that we broke in today's trading as well. We now tested this high from February 17th around 138. The threat of Greek default faded this week as the markets have taken the austerity measures proposed by Greece as good enough, and there was also some chatter that Germany and France were willing to take the lead for a bailout of Greece, according to a report published Friday. So that increased risk sentiment around the Greek situation and gave us a chance to move out of this trading zone we had been in the last 2 weeks. Today's high, meanwhile, was about a 4-week high for the pair. Our catalyst overnight was better than expected industrial production data from the Eurozone, where we saw output rise by 1.7%. So that helped to bolster prospects for first quarter growth in the Eurozone, and that gave the euro some strength in today's trading. Also, there was news that President Barack Obama was going to pick the San Francisco Fed President Janet Yellen to be the vice chairman of the central bank. She is rather dovish on interest rates, and that may have played a part in the weakness in the greenback in today's trading as well. Taking a look at that industrial production data, we see that the 1.7% increase on the month was much better than forecast and makes up for the decline we had seen in December. Also on the year, production was up 1.4%, so that broke us back into positive territory in terms of annual output. We can see that while we have matched the level of output that we had seen a year ago, we still remain far below the peak that we had prior to the start of the financial crisis. So this peak here came in the middle of 2008, right before we had our market meltdown and the start of the global recession. Taking a look back at another euro pair, here we're looking at the euro yen, and we see that in today's trading we broke above resistance right here around 124, and that coincided with our break in the euro dollar moving higher, so we reached a new high at 125.20. So that tests our high here from February 20. So we did see a bit of a correction following a test of that high, but we'll see what happens next week as we test this 125 level in next week's trading. Now, while the euro was gaining against its other rivals, the euro-Swiss franc pair fell sharply in favor of the Swiss franc after we had yesterday's Swiss National Bank decision here. The bank had increased both its growth and inflation forecasts, which strengthened the Swiss franc, and in today's trading we moved below this 1.46 level, which had acted as support yesterday. We did not stop until we tested the 1.4560 area in late New York trading. So we'll see at what point the Swiss National Bank will actually come to intervene in the market, as they have said that they do not want to see strong appreciation of the franc against the euro. So the last time we had a very big intervention was on February 6th, on February 5th, and we had been testing these same areas around 1.4550. So we'll see what happens when we approach that area next week. In news from the US, we saw February retail sales rise 0.3%, which bucked forecasts of a decline for the month as a result of the poor weather. So it seems that US consumers were willing to brace the weather, and the fact that the Super Bowl came in the beginning of February really helped purchases of electronics, mainly flat screen TVs. We had a rather large decline in car purchases during February, so if we exclude autos from total sales, we get a 0.8% rise. However, we did see January's total revised downward somewhat, so that was a slightly negative part of the release. In a second report, we had the UMich Consumer Sentiment. The preliminary version for the month of March dipped to 72.5 from February 73.6. So that undershot forecast, which had called for a slight gain, as we had both current conditions and expectations index decline in today's in the report. As you can see from the chart to the right, we've been ranging between 72.5 and 74 in this index the last 4 months. So while we consumer confidence has recovered from these lows we had seen at the beginning of 2009. Right now we seem to be moving more sideways. Here we're taking a look at the dollar-yen pair, and we could see that following the U.S. retail sales report, we rallied rather strongly, as the report was a positive for the U.S. economy. However, with the weaker than expected consumer confidence report, U.S. equities gave up some of their opening gains and fell into the negative, which caused the greenback to pair all of its earlier gains against the yen. By the end of New York trading, equities were trading rather flat, and so we had returned back to the level we were at prior to this move up as a result of the retail sales report. We are also now back at the level we were following the better than expected non-farm payroll report we had seen in the U.S. Last Friday. In one more bit of fundamental news, we had employment change for the month of February from Canada. We saw that the economy added 20.9 thousand jobs during the month, which beat forecasts and extended the job gains that the Canadian economy has seen the past several months. The unemployment rate, meanwhile, dropped down to 8.2%, which was also a better than expected result. Also, all the gains in employment this month were due to full-time positions, so that's a pretty good sign. We have been trading gradually lower in the US dollar Canadian dollar pair in the last 2 weeks, and we did have some volatility in yesterday's trading, but today, following the employment report, we saw the pair break below this support line and move down to the 1.0150 as today's low. So that actually took out our lows from 2009, and now we're going to be testing the parity level at 1-to-1. Looking at the pound dollar, we see that the greenback for the most part just was pressured today to end the week, as we've had an increase in risk sentiment around the Greece situation, perhaps around Eurozone growth as a result of the industrial production. And the pound dollar pair tested the area right at the 1.52 area level as resistance, and so it didn't manage to move above that, though it did have a rather strong rise in today's trading. There are further areas of resistance in this pair, as we had a rather sharp slide in the middle to end of February. So even if we move above the 152 level, we should still look for the 153 perhaps to be the next zone of resistance. Now let's take a look at the main releases to expect for next week. From the US, on Monday we will have data on the manufacturing sector, as we have industrial production data as well as the Empire Manufacturing Index. Tuesday we get data on housing starts as well as the FOMC interest rate decision, which is going to be a very important event risk for next week's trading. That will be followed on Wednesday by producer prices, and then on Thursday by consumer prices, so we get a good look at inflation figures. And then also on Thursday we will get another regional manufacturing report in the Philly Fed Index as well as the weekly jobless claims. Around the world, Tuesday we get an important economic sentiment from Germany, the ZEW economic sentiment. Wednesday the UK has its employment situation, the claimant count, as well as its monetary policy committee meeting minutes. On Thursday we have public borrowing numbers from the UK. And Friday we will close off with consumer prices and retail sales from Canada. So that will wrap up our coverage of the Forex market for this week. For more news, videos, and analysis, visit our site, FXTimes.com. I want to thank you for watching and wish you a great weekend.